This week we'll be having a look at Unilever, the consumer product behemoth that is located in Britain. I think just a few years ago it was located in the Netherlands, but recently they moved all of their businesses over to Britain. Now, Unilever is mostly well known for their brands like Axe, the Axe Effect, or also called Lynx, I think in Britain. They have many soaps like the brands of Dove, and also have many other consumer goods under their name, like for example Ben and Jerry's or Unox, or like many different brands. If you walk through the grocery store, you will find many of their products there, even though you didn't quite realize it. They might have been from Unilever. I'll quickly have a look here through just some of their brands. Like I said, Axe, Ben and Jerry's, Cif, Comfort, Dove, Equilibria, Lifebuoy, Sona, Sunsilk, Vaseline, The Vegetarian Butcher, Walls. They have so many brands. So yeah, what we see here is the financials for Unilever for the past 10 years. Now, quick side note here is that the financials are actually displayed in terms of dollars. Unilever is on many different exchanges, like the Britain one, like the Amsterdam one, and also in America. So like there's many currencies in which this company is traded, and I decided for this video to select the dollar value. So of course, if you want the value in your native currency, you have to do the translation there for yourself. So looking at their revenue here, what we see is in 2012 they scored a revenue of 64 billion, which has actually been decreasing for the past 10 years to 60 billion. Now, one thing that maybe like with a consumer brand like Unilever that you're going to have to realize is that many of their brands are very well known, and it's pretty much reached a point of maturity where there is not much more market share they can actually take from their brands. So a big way of growing for companies like Unilever or Procter and Gamble or like any of those kind of companies is to really start to acquire additional businesses. And this is also what Unilever is trying to do, and this is how they are supposed to increase their revenue. But we can see for the past 10 years is that it's not really happened, in all fairness. And I think recently Unilever is very much trying to go into the transition of more self-care products as opposed to food products. They also tried to obtain the GSC hand, which included brands like Sensodyne, for example, the very famous toothpaste brand. But I think that offer was rejected, and it actually spun out into a different company called Helion, which went live on the market, I think, last year. But this is very much the way in which Unilever tries to expand their business. And what we can see here as well, between 2016 and 2017, we see a pretty big revenue spike, which is because they actually acquired 23 different companies, which of course also raised their debt, but we'll get to that in a little bit. Overall, what we see here is that the revenue is decreasing. It's not even remaining stable, like in line with inflation, which is to say 2% a year. No, not even that. It's actually decreasing. So this is a bit of a risk sign, I think, for the future of this company, because at least for the past 10 years, management has not really been able to actually increase their revenue, even though they have been acquiring as well as selling some of their brands. Looking at earnings, though, it tells a slightly different story, which is to say that earnings are growing over the past 10 years, about 2% year over year, which is in line with inflation, which just kind of means that their earnings in reality really are kind of flat. But this is because their top line is actually decreasing, but they are able to increase their profit margins, which results in this 2% earnings growth, even though revenue growth is decreased by 1%. Looking at that debt level, a company like this has to expand by buying new companies, and therefore they need to make big upfront investments to actually increase their revenue. And this is what we saw here as well. Like I mentioned, 2016, 2017, they just added 14 billion of debt to their balance sheet to produce an increased revenue of 10 billion, which is probably worth it in my opinion. But the only problem is that the few years after that, their revenue has been decreasing again. So even though I think this investment was probably a good one, they were not able to come to fruition all that well, and that debt level remained relatively high, even though their earnings has actually been like quite high compared to the debt level. So they could actually pay off their debt a lot faster than they would than they're currently doing. but they are paying out a lot of their earnings to shareholders directly, which I think is to the deficit of the business itself, but we'll get to that in a little bit. Looking at excess cash, do you have some cash on hand? Always, not too much, but I think it's very much what we like to see. They use all the money that they have and don't have that much that is not used, which is good utilization of capital. Looking at market cap, it's been relatively flat as well, as it's grown about 2% for the past 10 years, which is again flat. It's in line with inflation. It's nothing really impressive to be looking at. Enterprise value, which is the entire value of the company. So this is the price that is on the market. So all the shares and the market cap that you buy on the open market itself, to which we add the debt and subtract the cash. Because if you want to, for example, take over a company like Unilever, of course you have to buy the shares from the market, but you also have to incur the debt that they have, and you get to take back that cash. It's the entire value of the company. And we can see that the enterprise value has grown a lot faster than the market cap has, which is to say that their debt level has been increasing while the rest of the company has remained relatively stable and flat, which is again not really a good look and not something that we're looking for. But maybe the company is well priced because it has these possible risks. Let's just continue looking at this company. EV/EBITDA ratio, how many years does it take before Unilever can pay itself back? On average, it's been 13.4 times, which is always kind of circling in the range between 11 and 14 and a half. It's quite a stable there as well, because of course the earnings and the revenue is not going up and down as much. It's a very stable company when it comes to that. There's no good years or bad years. People are always going to need their food, and people are always going to need the soap to make sure that the people in the workplace can continue to approach them, and they are not lepers because of their smell, which is fair enough. So yeah, the earnings and revenue are very much steadily holding. Looking at that debt level, we can see that their debt was quite low. I think in 2012, 1.5 times, because we do expect them to have some debt because they need to make acquisitions to actually keep on growing as a company. So this is something that is inherent in the business that they're in, but we can see that that debt level has actually been steadily increasing for the past 10 years, even though it's not really in line with their increase in earnings, which is a bit tricky to see. Now they're currently ranging at about the level that I think I would accept for a company, so I think I'm going to give them a pass here, but they are really getting into very risky territory. Looking at that cash flow, we can see it's again been quite stable, flat, which is to say also even actually that it has been decreasing, because if you take into consideration the inflation over the past 10 years, or the past year has been especially bad, but on average it's been about 2 point something percent, and they have been growing at 0%, so they are very much underperforming inflation, which again means that the business is kind of declining in the long haul. Capital expenditure, though, it tells a kind of a different story, which is to say that they have less capital expenditure. They are more efficient in running their business, which is very much what we like to see. The costs are coming down, even though their earnings is remaining stable, and this is why we can see some increase in cash flow because of that, mostly because they're able to press the cost that they have as a business. So this brings us to free cash flow, the very interesting part for us as investors, because it's everything that's remaining in their vault after the end of their fiscal year. This is all the money that they have to play with, that is like basically earnings that's just laying there for them to invest. And what we see here is a 1% growth year over year, which is it's not a lot, but they already have pretty high numbers, and it's very stable business. So I'm gonna go ahead and say this is actually quite okay, even though the numbers there are very low. Now we look at the next column here. So like, what is it that they actually do with their free cash flow? Because they have quite some free cash flow. So how exactly do they utilize this? Well, Unilever pays out a relatively lucrative dividend to their shareholders every quarter. So a lot of their free cash flow is actually being paid out to that. And additionally, what we see here as well with the share count is that the share count is slowly diminishing, which is to say that Unilever is very much is very much buying back shares. And this is where a lot of their free cash flow is going towards. So instead of actually paying down their debt or making bigger acquisitions to increase the business as a whole, to increase the top line revenue, to increase the bottom line earnings, they actually decide to just keep on rewarding investors for holding their shares by buying back shares or divvying it out, which I think as an investor is very nice, but it also means that the growth prospect of this company is very, very minimal, which is actually not something that I like to see. I like to have a little bit of growth, a little bit of future proofing when I look at a company, and I don't think Unilever quite checks the box when it comes to that. Looking at free cash flow per share, we can see that has been increasing. Now this is mostly again because even though the free cash flow is growing by about 1% per year, their share count is decreasing. So because of that, of course, the margins for the free cash flow per share is increasing, even though their earnings really aren't increasing that much. So what we mostly see here is that it's an inflated EPS. Most of the time, basic investors, they will look at earnings per share, and if that's growing, they think that the company is growing. But when we look at Unilever, we see that the company is not growing, but the earnings per share is growing because the amount of shares are decreasing, which gives like an artificial sense that the business is increasing, which if you really look at the numbers, it's actually not true. It's mostly because they're using their money to inflate the earnings per share number. Now this is the share price for the last 10 years, not that much to talk about here, ranging between $40 and $60. Free cash flow yield on average been about 7%, it has been as low as 3.6%, which has been a crazy year, and as high as 9.3%. Okay, so now we have some financials to base our projections on, and their financials are actually quite steady, which I think is makes our forecast more robust in the future. So earnings growth on average has been growing at 2.3% a year, but this is even though their revenue has been decreasing, and I think that is a very negative sign. So I'm just going to go ahead and say that even though they've been growing historically for 2.3% earnings, I think in the future that's going to come down unless they can heavily capitalize on optimizing their business or make some very big acquisitions. I think earnings are going to come down. And when I make an estimate and I want to be conservative with my estimate, I very much like to look at conservative numbers. So I'm going to give them 1.5% year over year. So this ends up with a 15 billion earnings 10 years from now. I give them a market multiple of 12 times, even though historically, to be fair to them, they have been trading at 13.4, and I think 12 is really towards the bottom end of their historical multiples. But again, it might just come back down to that multiple, and I want to be conservative. I want a conservative estimate, and if that beats the stock market, that's when I'm interested. So given the multiple, it gives me an enterprise value of 180 billion, to which we subtract the debt, add the cash, gives me a market cap of 146 billion, divided by the amount of shares gives me a share price 10 years from now in dollars of $56.25. Now with free cash flow, I'm going to do a similar thing. Even though their free cash flow has not been growing at 1.5% really, let me actually quickly go have a look at that. Quickly have a look at the actual decimal place there. Let's increase the decimal. It's been increasing by 1%. So I actually think what I'm going to do is I'm going to continue this onwards, the trend of 1% free cash flow increase that they have been doing for the past 10 years. And I'm going to give them a free cash flow yield of 7.5%, which is slightly above their historic average, but well above what they've been trading at for the past 3 years. So I think, again, this is a nice conservative estimate that is still very much within the realm of actual possibility. So with the free cash flow yield of 7.5% and a free cash flow growth of 1%, I expect their stock price 10 years from now to be $25.17. If I take half of both these projections, I get a share estimate 10 years from now of $54.21. Right now on the open market, I can buy as many shares as I want for pretty much $50. So in the upcoming 10 years, I expect their share price to increase by about $4, which is really, really not much. It's about a 0.9% compounding annual growth rate. But of course, like I mentioned, what Unilever does is they do not invest as much in growth or like in the expansion of their business, but they're mostly using their money to reward their shareholders directly. So if you hold this company for 10 years as a shareholder, you will make use of all the compensation that they give you, as a shareholder in the way of dividends or in the way of share buyback. So if we actually include all the free cash flow that you are to be expecting in the upcoming 10 years, which is what we can see here. First, we buy the share for about $50. This is the free cash flow that we get every single year. And then at 10 years from now, we sell the share for $54. We get an intrinsic rate of return of 9.4%, which I think is a very robust estimate, especially considering the steadiness of their business and how easy it is to project a business like this. I think I'm quite confident in saying that this is quite a reflective number of where they might be heading in the future. So even though, like I always say, on average the stock market is returning 10%, and this includes the amazing companies like Louis Vuitton, which has seen incredible growth over the past few years, or the Besi Semiconductors, which we also looked at a few weeks ago, which was returning about 25%. And these amazing performing companies are then cancelled out by the terrible performing companies, or even the companies who actually go into bankruptcy, because of course those are also included. If we sum all those companies together, we get an average return of 10%. And I think that's a pretty low bar, I think, for actual good value investors to look at. But when we look at Unilever, we can actually see that they are underperforming the average return of the stock market, which is to say, I don't think it's a company worth investing in, considering how their debt has been piling up for the past 10 years, considering how less growth potential there is for this company. I do not think Unilever is a good investment, but it does give a very steady dividend payout every single quarter, and it does increase your earnings per share because they are buying back their shares so much. So I think it's a relatively safe-ish company if they can actually maintain that debt level. But I think the risk reward for this company is really not there for me. So I would personally not be interested in Unilever. But maybe when the price comes down to, let's say, about 45, maybe even $40, maybe at that point I'll be interested. But until then, I'm going to stay away from this. Of course, it's not financial advice. You can make your own decision. So this was Unilever. Thank you very much for watching. Don't forget to like, subscribe, and all that good stuff. And I'll see you in the next one. Cheerio.